Hey everyone, welcome to Quantum Wallet, where we break down complex financial topics into actionable insights that help you take control of your money. I'm Den, your expert stock market financial analyst, and today we're diving deep into personal finance, part 2. Saving and investing for the future. Now that we've tackled budgeting, emergency funds, and managing debt, it's time to focus on the exciting part of personal finance, saving and investing. This is where you start building wealth and securing your financial future. The difference between saving and investing. Now, let's start by understanding the difference between saving and investing. Both are essential, but they serve different purposes. Saving is setting aside money for short-term goals or emergencies. It's about preserving your capital and keeping it accessible. Savings are typically stored in low-risk accounts like savings accounts or money market accounts. Investing is putting your money to work to grow over the long term. It involves taking calculated risks by purchasing assets like stocks, bonds, or real estate. Investments have the potential for higher returns, but come with greater risk. Step 1. Setting financial goals. Before you start saving or investing, it's crucial to set clear financial goals. Ask yourself, what am I saving or investing for? How much money will I need? What's my time horizon? Here are a few examples. Short-term goals, a vacation, buying a car, or building an emergency fund, 1-3 years. Medium-term goals, a down payment on a house or starting a business, 3-10 years. Long-term goals, retirement or funding your child's education, 10+ years. Your goals will determine whether you should save or invest and what types of accounts or assets to choose. Step 2. Building a savings strategy. For short-term goals, focus on saving in low-risk, easily accessible accounts. Here are some tips. Choose the right account. High yield, savings accounts. These offer better interest rates than traditional savings accounts, helping your money grow faster. Certificates of deposit, CDs. If you don't need immediate access to your money, CDs offer slightly higher returns in exchange for locking up your funds for a set period. Money market accounts, a hybrid between savings and checking accounts. These often provide competitive interest rates and some check writing privileges. Automate your savings. Set up automatic transfers to your savings account to ensure you're consistently setting money aside. Use savings buckets. Many banks and apps allow you to create buckets or sub-accounts within your savings account. Use these to separate funds for different goals, like a vacation fund or a wedding fund. Step 3. Investing for long-term growth. When it comes to long-term goals, investing is key. Here's how to get started. Understanding investment options. Stocks. Stocks represent ownership in a company. When you buy shares, you're investing in that company's future growth. Stocks have the potential for high returns, but come with higher risk. Bonds. Bonds are essentially loans you give to governments or corporations. In return, they pay you interest. Bonds are generally less risky than stocks, but offer lower returns. Mutual funds and ETFs. These are collections of stocks, bonds, or other assets bundled together. Mutual funds are actively managed by professionals, while ETFs, exchange-traded funds, are passively managed and often have lower fees. Real estate. Investing in property can provide income through rent and long-term appreciation. Real estate investment trusts, TIS, allow you to invest in real estate without owning physical property. Retirement accounts, 401k, offered by employers, often with matching contributions. Contributions are pre-tax, and the money grows tax-deferred. IRA, individual retirement account, available to anyone, with traditional IRAs offering tax-deferred growth and Roth IRAs offering tax-free growth. How to start investing. Determine your risk tolerance. Your risk tolerance depends on factors like your age, income, and financial goals. Younger investors can typically take on more risk because they have more time to recover from market downturns. Open an investment account. If your employer offers a 401k with matching contributions, start there. It's essentially free money. For other goals, consider opening a brokerage account or an IRA. Diversify your portfolio. Don't put all your eggs in one basket. Spread your investments across different asset classes, industries, and regions to reduce risk. A common rule of thumb is to allocate a percentage of your portfolio to stocks equal to 100 minus your age. For example, if you're 30, consider holding 70% in stocks and 30% in bonds. Invest regularly. Use dollar-cost averaging to invest a fixed amount of money at regular intervals. This strategy reduces the impact of market volatility and helps you build wealth consistently. Monitor and adjust. Review your portfolio at least once a year to ensure it aligns with your goals and risk tolerance. Rebalance if necessary by selling overperforming assets and buying underperforming ones. Step 4. Tools and resources for saving and investing. Apps and platforms. Acorns automatically invests your spare change. Robinhood, a beginner-friendly app for trading stocks and ETFs. Betterment, a robo-advisor that creates a diversified portfolio based on your goals. Financial advisors. If you're unsure about investing, consider consulting a financial advisor. They can help you create a personalized investment strategy. Educational resources. Websites like Investopedia and Morningstar offer free articles and tutorials on investing basics. Books like The Intelligent Investor by Benjamin Graham and A Random Walk Down Wall Street by Burton Malkiel are great starting points. Final thoughts on saving and investing. Saving and investing are the cornerstones of building wealth. By starting early, staying consistent, and using the right tools, you can achieve your financial goals and secure your future. In the next part of the series, we'll discuss the importance of retirement planning and how to ensure you're financially prepared for your golden years. Stay tuned. Retirement planning, securing your future. Welcome back to our comprehensive guide to personal finance. In this section, we'll discuss one of the most important aspects of financial planning: retirement. Retirement planning is about ensuring you have enough money to live comfortably when you're no longer working. The earlier you start, the better your chances of achieving financial independence in your golden years. Step 1. Define your retirement goals. Before you start planning, think about what you want your retirement to look like. Ask yourself, at what age do you want to retire? Where do you want to live? Will you stay in your current home, downsize, or move to a different location? What kind of lifestyle do you envision? Will you travel, pursue hobbies, or spend time with family? Your answers will help you estimate how much money you'll need to retire comfortably. Step 2. Calculate your retirement needs. A common rule of thumb is that you'll need about 70–80% of your pre-retirement income to maintain your current lifestyle in retirement. However, this can vary based on your goals and expenses. Here's how to calculate your retirement needs. Estimate your annual expenses. Consider housing, healthcare, food, transportation, and discretionary spending like travel or hobbies. Factor in inflation. Inflation erodes purchasing power over time. Use an average annual inflation rate of 2 to 3% when calculating future costs. Account for longevity. Plan for a retirement that lasts 20–30 years or more. It's better to overestimate than run out of money. Use online retirement calculators to get a clearer picture of how much you'll need to save. Step 3. Take advantage of retirement accounts. Retirement accounts offer tax advantages that help your money grow faster. Let's look at some of the most popular options. Employer-sponsored plans. 401k plans. Many employers offer 401k plans, which allow you to contribute pre-tax dollars. Some employers also provide matching contributions, which is essentially free money. In 2025, the annual contribution limit is $22,500, with an additional $7,500 catch-up contribution for those aged 50 and older. 403b plans, similar to 401ks, but designed for employees of nonprofit organizations, schools, and government agencies. Individual retirement accounts, IRAs. Traditional IRA. contributions are tax deductible, and your investments grow tax deferred. You'll pay taxes when you withdraw the money in retirement. Roth IRA. Contributions are made with after-tax dollars, but your money grows tax-free, and qualified withdrawals are tax-free. Roth IRAs are especially beneficial if you expect to be in a higher tax bracket in retirement. Self-employed plans. SEP IRA or Solo 401k. Ideal for freelancers, contractors, and small business owners, offering high contribution limits and tax benefits. Step 4. Maximize your contributions. To ensure you're saving enough, aim to contribute at least 15-20% of your income to retirement accounts. If that's not feasible right now, start with what you can afford and increase your contributions annually or whenever you get a raise. Step 5. Diversify your investments. The money in your retirement accounts should be invested to grow over time. A diversified portfolio is key to balancing risk and reward. Here's a general guideline. Stocks provide growth potential and are ideal for younger investors with a longer time horizon. Bonds offer stability and income, making them suitable for those nearing or in retirement. Mutual funds and ETFs provide diversification in a single investment. As you approach retirement, gradually shift your portfolio to more conservative investments to protect your savings. Step 6. Consider other retirement income sources. In addition to your savings and investments, you may have other sources of retirement income. Social Security. Social Security benefits are a significant income source for many retirees. You can start claiming benefits as early as age 62, but your monthly payments will be higher if you wait until your full retirement age, typically 66 or 67, or even age 70. Pensions. If you're lucky enough to have a pension, understand how much you'll receive and how it fits into your retirement plan. Annuities. Annuities provide guaranteed income for life in exchange for an upfront investment. They can be a good option for those seeking financial security in retirement. Step 7. Plan for healthcare costs. Healthcare is one of the largest expenses in retirement. Here's how to prepare. Medicare. Medicare begins at age 65, but it doesn't cover everything. You may need supplemental insurance or a Medicare Advantage plan. Health savings accounts, HSAs. If you're enrolled in a high-deductible health plan, consider contributing to an HSA. Contributions are tax-deductible, and withdrawals for qualified medical expenses are tax-free. Step 8. Protect your retirement savings. Avoid early withdrawals. Withdrawing money from retirement accounts before age 59 typically incurs a 10% penalty and taxes. Have a withdrawal strategy. Plan how much you'll withdraw each year to avoid running out of money. A common rule is the 4% rule, which suggests withdrawing 4% of your portfolio annually. Consider long-term care insurance. This can help cover the costs of nursing homes, assisted living, or in-home care. Step 9. Monitor and adjust your plan. Retirement planning isn't a one-and-done process. Review your plan annually and adjust as needed based on changes in your income, expenses, or goals. Final thoughts on retirement planning. Retirement planning is a lifelong process that requires discipline, consistency, and adaptability. By starting early and making informed decisions, you can build a secure and fulfilling retirement. In the next part of this series, we'll explore advanced topics like estate planning, leaving a financial legacy, and how to protect your wealth for future generations. Stay tuned. Estate planning. Protecting your legacy. Welcome to the final part of our comprehensive personal finance series. In this section, we'll discuss estate planning, an often overlooked yet essential aspect of financial management. Estate planning ensures that your assets are distributed according to your wishes and that your loved ones are taken care of after you're gone. It's not just for the wealthy. Everyone can benefit from having an estate plan. What is estate planning? Estate planning is the process of organizing your financial and personal affairs to ensure they are managed and distributed as you intend after your death. It involves more than just writing a will. It includes tax planning, healthcare directives, and protecting your loved ones from unnecessary legal complications. Step 1. Why estate? Planning matters. Control over your assets. Without an estate plan, state laws will determine how your assets are distributed, which may not align with your wishes. Minimizing taxes. A well-structured estate plan can reduce estate taxes and maximize the inheritance for your beneficiaries. Avoiding probate. Probate is the legal process of distributing your assets, which can be time-consuming and costly. Estate planning helps bypass this process. Providing for dependents. Ensure your children, elderly parents, or other dependents are financially secure. Healthcare decisions. Establishing healthcare directives ensures your medical preferences are respected if you're unable to communicate them. Step 2. Key components of an estate plan. 1. Last will and testament. A will outlines how your assets will be distributed and names an executor to carry out your wishes. You can also designate guardians for minor children in your will. 2. Living trust. A trust allows you to transfer assets to beneficiaries without going through probate. Revocable trust. You retain control over the trust and can modify it during your lifetime. Irrevocable trust. Once established, it cannot be changed, but it offers better protection from taxes and creditors. 3. Power of attorney. A financial power of attorney allows someone you trust to manage your finances if you're unable to do so. 4. Healthcare directives. Living will specifies your medical treatment preferences in case of incapacitation. Healthcare proxy appoints someone to make medical decisions on your behalf. 5. Beneficiary designations. Ensure your retirement accounts, life insurance policies, and other assets have up-to-date beneficiary designations. 6. Letter of intent. This document provides additional instructions for your executor or family, such as funeral arrangements or personal messages. Step 3. Tax planning in estate planning. Taxes can significantly impact the value of your estate. Here's how to minimize their effect. Estate taxes. In 2025, the federal estate tax exemption is $12.92 million per individual. Estates exceeding this amount are subject to taxation. Use trusts or lifetime gifting strategies to reduce the taxable value of your estate. Gift taxes. You can give up to $17,000 per year per person without incurring gift taxes. This is a great way to pass on wealth during your lifetime. Generation Skipping Transfer Tax, GSTT. This tax applies to transfers made to grandchildren or other distant relatives. Proper planning can help avoid it. Charitable giving. Donations to qualified charities can reduce your taxable estate while supporting causes you care about. Step 4. Protecting your estate. Insurance. Life insurance can provide financial security for your family and help cover estate taxes or debts. Asset protection. Use trusts or legal structures to shield your assets from creditors or lawsuits. Business succession. Planning. If you own a business, create a plan to ensure its smooth transition to the next generation or new ownership. Step 5. Reviewing and updating your estate plan. Life changes, and so should your estate plan. Review it regularly, especially after major life events like marriage or divorce, the birth of a child or grandchild, significant changes in your financial situation, the death of a beneficiary or executor. Step 6. Tools and resources for estate planning. Estate planning software. Tools like Trust and Will or LegalZoom can help you create basic estate planning documents, financial advisors, and attorneys. For complex estates, consult an estate planning attorney or financial advisor to ensure your plan is legally sound and tax efficient. Educational resources. Books like Plan Your Estate by Dennis Clifford provide a comprehensive guide to estate planning. Final thoughts on estate planning. Estate planning is a gift to your loved ones. It ensures your legacy is protected, your wishes are honored, and your family is spared unnecessary stress during a difficult time. That concludes our comprehensive guide to personal finance. We've covered budgeting, saving, investing, debt management, retirement planning, and estate planning. By taking these steps, you're not just managing your money, you're building a secure and prosperous future. Thank you for joining us on this journey. If you found this series helpful, don't forget to like, subscribe, and share. Let us know in the comments what topics you'd like us to cover next. Until then, take charge of your finances and start building the life you deserve. Insurance planning, protecting what matters. Welcome back to our series on personal finance. In this section, we'll explore insurance planning, an essential component of financial security. Insurance acts as a safety net, protecting you and your family from unexpected events that could derail your financial plans. Let's dive into how to choose the right insurance and integrate it into your financial strategy. Step 1. Understanding the importance of insurance. Insurance transfers financial risk from you to an insurance provider. It ensures that you or your family are not burdened with significant expenses in case of accidents, illness, or other unforeseen events. The key types of insurance everyone should consider include health insurance. Covers medical expenses, including hospital stays, surgeries, and prescriptions. In the U.S., health insurance is often provided through employers or purchased via the health insurance marketplace. Life insurance provides financial support to your dependents in the event of your death. Two main types. Term life insurance covers you for a specific period and is more affordable. Whole life insurance offers lifelong coverage and builds cash value over time. Disability insurance replaces a portion of your income if you're unable to work due to illness or injury. Long-term disability insurance is especially important for those in physically demanding jobs. Homeowners or renters insurance protects your home and belongings from damage or theft. Renters insurance is affordable and ensures your possessions are covered even if you don't own the property. Auto insurance, legally required in most states, it covers vehicle damage, liability, and medical expenses related to accidents. Long-term care insurance covers the cost of assisted living, nursing homes, or in-home care, which can be a significant expense in later life. Step 2. How much insurance do you need? Determining the right amount of coverage depends on your financial situation and life stage. Health insurance. Opt for a plan that balances premiums, deductibles, and out-of-pocket maximums. Life insurance. A common rule is to have coverage worth 10-12 times your annual income. Disability insurance. Aim for a policy that replaces at least 60% of your income. Step 3. Choosing the right policies. When shopping for insurance, consider the following. Reputation of the insurer. Research the company's financial stability and customer reviews. Policy details. Understand what's covered and what's excluded. Premiums and deductibles. Ensure the premiums fit within your budget and the deductibles are manageable. Riders and add-ons. Customize your policy with options like critical illness riders or accidental death benefits. Step 4. Regularly review your insurance needs. As your life circumstances change, so do your insurance needs. Review your policies annually and update them after major life events like marriage, having children, or buying a home. Final thoughts on insurance planning. Insurance is an investment in your peace of mind. It provides a financial safety net that protects your assets and ensures your family's well-being. Take the time to evaluate your needs and choose the right coverage. In the next section, we'll cover wealth-building strategies, focusing on creating multiple income streams and achieving financial independence. Stay tuned. Building wealth. Creating multiple income streams. Welcome to the final section of our personal finance series. In this part, we'll discuss wealth-building strategies with a focus on creating multiple income streams to achieve financial independence. Building wealth isn't just about saving, it's about making your money work for you. Step 1. The importance of multiple income streams. Relying on a single source of income can be risky. Diversifying your income ensures financial stability and accelerates wealth creation. Let's explore the different types of income. Earned income, money you make from your job or business. While essential, it's limited by your time and effort. Passive income, income generated with minimal ongoing effort, such as rental income, royalties, or dividends. Portfolio income, earnings from investments including stocks, bonds, and real estate. Step 2, how to build multiple income streams. 1. Investing in the stock market. Invest in dividend-paying stocks or ETFs to generate regular income. Reinvest dividends to compound your wealth over time. 2. Real estate investments. Rental properties can provide steady cash flow and long-term appreciation. Consider real estate investment trusts, REITs, if you prefer a hands-off approach. 3. Side hustles. Leverage your skills or hobbies to start a side business. Popular options include freelancing, tutoring, or selling products online. 4. Creating digital products. Write an ebook, create an online course, or develop software that generates royalties or sales. 5. Building a business. Start a scalable business that generates income beyond your active involvement. Examples include e-commerce, franchising, or consulting. Step 3. Automate your wealth-building process. Pay yourself first. Set aside a percentage of your income for savings and investments before paying expenses. Use automated tools. Automate transfers to savings and investment accounts to stay consistent. Monitor and rebalance. Periodically review your investments and adjust them to stay aligned with your goals. Step 4. Avoid common wealth. Building mistakes. Over-leveraging debt. Avoid excessive borrowing for investments or lifestyle upgrades. Chasing quick wins. Stay wary of get-rich-quick schemes and focus on sustainable strategies. Neglecting risk management. Protect your wealth with adequate insurance and a diversified portfolio. Final thoughts on wealth building. Building wealth is a journey that requires patience, discipline, and strategic planning. By creating multiple income streams and making smart investments, you can achieve financial independence and live life on your terms. Thank you for joining us in this series. If you found it valuable, please like, share, and subscribe to our channel, Quantum Wallet. Let us know in the comments what financial topics you'd like us to cover next. Remember, the best time to start building wealth is today.